I think first of all, we must understand that we are now in a world which has changed a lot recently, and a lot of investors worry about risk of raising interest rates. That's the first thing. And second thing, in terms of volatility, last year was a very low volatility environment, and we have seen since the beginning of the year that volatility has picked up sharply. So it's when you are in this kind of environment, we need to find a strategy that is able to adapt to this changing world. And basically, Oddo Credit Opportunities, its philosophy is really to follow the evolution of the markets and to adjust its risk to the current environment. And that means to be flexible. Flexibility is a key word of this strategy, and flexibility on one side on the investment universe, but also in the way how you manage the different risks which are currently in a bond portfolio, risk of interest rate, and as it is mainly invested in credit product, the risk of credit. The fact that the kind of the investment process for this strategy is done on the 3 steps. First one, and it's done every week, we are looking at the market, trying to figure out what is the new environment, and now so we define the new budget risk, and it can be lower, it can be higher, and we decide every week that. Second step, once we decided how much risk we want to take in this strategy, we define where we want to invest it. And for that, we have 4 different segments: high yield, investment grade, emerging market bonds, and covered bonds, which are the lowest risky asset class. And basically, we do that also on a weekly basis, and we adjust the different percentage on each of these segments on a weekly basis. Then, third step, when we decided in which segment we want to invest, we need to decide which bond we are going to buy or to sell on a weekly basis also. And that is done, and that's very important because Oddo BHF Asset Management is really a company which base is analysis on fundamentals. So basically what we are doing, we have currently 9 high yield analysts and 6 investment grade analysts, and we ask them what are the best names in each of the sectors they are covering. So basically we invest in these names, so we have really a portfolio which is based on convictions of our analysts in terms of credit. The high yield market is definitely where we are comfortable to invest in. I think when you talk about fixed income fund, corporate bond fund, what is key is carry, because the carry is what brings you the return. It's one of the most highest elements of return. And this carry enables also to waive some volatility in the future. If you look at govies, or if you look at investment grade bonds, you have very, very low carry, very low yield. Where you can find yield is on the high yield market. And basically, when you talk about credit, but especially in high yield, what is absolutely key is to see if there is growth. And today, global growth is around 4%. So when you have growth, it's obvious that it is a big support to the credit. Secondly, on the corporate level, we've seen that since the 2008 and 2011 crisis we had globally and in Europe respectively, corporates made a lot of efforts to improve the quality of their balance sheet. So today, and we've seen that the first quarter of this year, results from corporates are pretty good. So they improve the capability of generate free cash flows, and that improves the credit parameters of this company. So that is a strong support. And we think that maybe being on high yield is a good place to be, especially in this environment where there is growth. Yeah, it's very important because, as I mentioned earlier, I think that is where the major risk is around today. We've seen that already in the US. We have seen that inflation is picking up, and it is driven especially by the increase of the labor cost, and it will come also in Europe. You remember that in January this year we had in Germany the IG Metall asking for increase in wages. We are seeing that in France also now, and we will see that everywhere. Why? Because for over the last 10 years, people did not get any increase in wages because of the two crises. So we will have this pressure from the labor market to see higher rates. On the second hand, we already have seen on the commodities market that pricing are going up, not only on oil, but also in metals, in whatever commodities you look at. So there is potential inflation already seen in the US, but starting to pick up in Europe also. And we believe that when you see where the German bonds are trading today, you think that there is probably a big risk to see these rates going up in the futures. The timing is not very clear because it's always a bit going up and down, but the trend seems to be pretty clear. So it's a big problem when you are managing a bond fund. So what we do in Oddo Credit Opportunities, we have the flexibility to manage this risk. And what we do is that for the time being, we are strategically covering this interest rate risk through futures, which is a highly liquid market. So we have the capacity to reduce this duration risk. And over the last 18 months or so, we were around zero in terms of duration. We came down a bit negative, a bit positive, but around zero, which is for us the good way to invest in this current environment and in the bond market.